In this episode, we speak with Frank Karl, Managing Director of Kayne Anderson's Private Credit Strategies and President of Kayne Anderson BDC. Kayne Anderson Private Credit, the direct lending arm of Kayne Anderson Capital Advisors, has deployed over $14 billion since 2011 across senior credit funds, BDCs, and other vehicles, managing more than $7 billion in assets. The firm focuses on capital preservation through secured cash flow generating investments in established middle market companies, targeting stable businesses for attractive risk-adjusted returns. Frank joined Kayne Anderson in 2013 and has focused on private credit strategies throughout his tenure. He was previously a member of Houlihan Lokey's financial restructuring group, advising debtors and creditors, and holds a BBA magna cum laude from Notre Dame. Kayne Anderson Private Credit was recently recognized as a top private credit firm of 2025 by GrowthCap. I'm your host, RJ Lumba. We hope you enjoyed the show. If you liked the episode, click to follow.
RJ Lumba is the managing partner of GrowthCap and the executive chairman of Market Insight Media. He is the host of Growth Investor, a podcast featuring today's best investors, executives, and founders. In the minutes ahead, we'll uncover insights and strategies for accelerating growth and succeeding in business.
Frank, great to see you. Thanks for taking the time.
RJ, thanks for having me.
So this conversation comes on the heels of me meeting a few of your team members who were in New York last week. Great group of guys, Liam, Ollie, and Rick. And so we had a chance to chat a bit about, Kayne Anderson Private Credit. Maybe to kick off, because folks in our audience may not be as familiar with this pocket of capital within the overall Kayne Anderson umbrella, but if you give us a little bit of history to the private credit group, that would be great.
Appreciate that, and glad you got to meet some folks on the ground on the team in New York. Kayne Anderson has been around since the mid-1980s, really a history as an energy investor. Now have a large real estate investment group. The private credit team is the newest strategy at Kayne Anderson and was formed in 2012. So not a lot of change, right, as far as what markets we're, attacking as an organization. As I mentioned, Kayne Anderson Private Credit formed in 2012. I joined in 2013. The group was formed with a clear objective, right? Build a scaled institutional quality direct lending platform focused on the core middle market. Today, we manage about $8 billion of AUM with a team of 45 people. From day one, the strategy has been senior secured, first lien lending to private equity-backed businesses in that core middle market. I think it's worth sort of defining that a little bit, right? Mm-hmm. We're in the $10 to $75 million EBITDA space. Our median is about $35 million. That's, I think, very different than where much of the market has gone. We see a lot of platforms with average EBITDA of $200-300 million. Clearly, I've spent a lot of my career here at Kayne Anderson. I've had the privilege of helping build the platform, really from the ground up, spend time in originations, execution, capital formation, and helped lead the formation and IPO of KBDC, which is our public BDC. Took that public almost 2 years ago. It's roughly a third of our total AUM and, core part of the franchise. Before Kayne, I actually started my career in restructuring at Houlihan Lokey, which I think, has been helpful, right, as a credit investor, and sort of formed how I think about risk.
When you think about starting a private credit group from the very foundation, the first thing is, okay, how do we get the correct level of yield and not expose ourselves to too much risk? Defining the scope of opportunities you will focus on. Can you tell us a little bit about, from the get-go, did you decide we are going to focus on these certain sectors?
Yeah, I think it's been consistent since the get-go. Let's start there, right? There hasn't been any change. And part of that is target, scale, business size, right? The market conditions around how many lenders are there, how much capital has been formed, like where do you see the best sort of supply-demand dynamics? We like it, in the space where we're playing. As far as actual end markets and industries that we're targeting, we're generalists by trade, right? We sort of follow the private equity market. There's some spaces, obviously, you don't like as much, energy, for example, tougher debt deals generally. We like to call it stable and staple industries. I think, saying boring industries is probably an easier way to put it. Distribution, business services, some healthcare, food manufacturing, distribution, packaging, industries and businesses that have been around for decades, and we think will continue to be around for decades. We're very intentionally and have very intentionally not been a software lender. I can't say that we saw AI coming, right? That would be disingenuous to say in 2012 we were talking about that risk. But I think it goes back to the sort of stable and staple point, right? We like businesses and industries that are growing at sort of, GDP plus. Those tend to trade for, call it 7 to 10 times. You can usually lever them more like 4 times on average, right? Where you think there's more cushion in those structures. We're not doing, sort of an LTV lending strategy. And that's helped us right now, right? We don't have, exposure to parts of the market that are driving, frankly, a lot of negative headlines around private credit. As an aside, not as many negative headlines around all the private equity money that's invested in those businesses, but that's sort of a different conversation. So I think it's been industries that we understand, businesses that we have experience with, lever those conservatively. And we think that structuring helps conserve your capital, protect your capital. And we've been intentional about investing in markets where we can structure these things conservatively.
Mm-hmm. There's this kind of often heard refrain of, capital is a commodity. And with the types of situations you're focused on, those are fairly, in some regards conservative, right? You're not going out on a limb on these investments. So I imagine there's some competitiveness in terms of the capital providers going after the same companies and situations. How do you typically differentiate Kayne Anderson when you're talking to a management team?
Yeah, I mean, look, these markets are competitive, full stop, right? No doubt about it. I think that one thing that we feel differentiates us, and this, it kind of might be a little bit of a surprising answer, is that we've been doing the same thing for 13 years at Kayne Anderson. The partners did this at Cerberus prior, investing in the same markets, same types of businesses. And I raise that because, to your point, everybody's money is green, right? And it takes a very long time to build a reputation in the market of doing what you say you're going to do, being commercial, being reasonable, also being pragmatic in tougher times. So I think we've done a very good job of building a network of private equity sponsors, but also through non-sponsored channels and doing lending, right, directly with businesses, et cetera, where your reputation matters a ton and it's not something that happens overnight. Difficult to show up and say, hey, I have money, let me be a senior lender. If something goes wrong, you have no idea how I'm going to act. Like, that's a hard sell versus, hey, we've been doing this in exactly this market for 20 years. Again, we didn't chase going up market, which I think is, a lot of people have done, for the sake of asset aggregation. We didn't chase, let's call it practice management roll-ups when that was extremely hot and very aggressive and people were underwriting a ton of EBITDA adjustments. We didn't chase pieces of the market that were best suited just to scale. We focused on markets where we thought we could build portfolios that had very attractive levels of relative risk return.
Mm-hmm. You mentioned founding or setting up KBDC. Can you tell us a little bit about the thought process around that?
Yeah, I mean, I think that there's a couple of things, right? Clearly, we're a GP, we're an asset manager. Having a public BDC is a permanent source of capital, which is a material benefit, right, to us and as part of our platform, right? It's capital that's always there. As dollars come back, you're able to reinvest those. It helps support our clients, right? It's another source of capital for what's available. And frankly, we had a lot of investors, particularly prior to IPO, that, were looking for some sort of incremental liquidity in the asset class alongside of us. Public BDC, natural fit there. And frankly, there are other parts of Kayne Anderson that have managed publicly traded vehicles in the past where we could leverage some of that internal expertise. Like, we weren't sort of whiteboarding, how do you take one of these entities public? We had a lot of the expertise in-house, which was clearly helpful. And look, the public BDC market, I don't want to just skirt by it, has been under some duress the last few months. A lot of these things are trading at substantial discounts to NAV. Ours has been trading in sort of the high 80s, which, no one's jumping up and down about, but it's in that top quartile. And the only folks trading higher than us are Blackstone, Ares, Sixth Street. Other than that, everybody's trading a little bit below that. So I think the market has seen, talking about relative risk return profiles, our core middle market focus is a little bit of a differentiator in the public BDC world where it's mostly much larger market players. Like, the market has been receptive to the relative value add for what we're doing. But unfortunately, 30% of that market is loans backed by software businesses. And there's a little bit of correlation and baby with the bathwater sort of impact there.
Is there an example of a portfolio company and how you got involved and maybe how you structured the deal and, the relationship that's evolved with the management team that helps kind of the audience understand the value of a partnership with Kayne Anderson Private Credit?
There's a handful of those situations where, we've built really long-term relationships with founders, families that own their businesses, and really help to unlock a lot of value, right? Whether that's financing an acquisition that, really accelerated growth, and you've now got a platform that's, significantly more valuable than the standalone business, or, sort of doing one-off financing projects. I think of an example. We finance a business called Gusmer Enterprises. They make custom filters that are used in a huge array of industries, like basically pharmaceutical companies, food and beverage, really like very specialized custom filters that are consumable, used in production. That business and the family, had a very large pipeline of new business being onboarded over the next few years. You think about pharmaceutical, right? There's a few year lead time on this stuff. And we actually financed a new facility for close to $50 million in North Carolina. And while that facility was under construction, they had a big sign out front that said, the new home or the new facility of Gusmer Enterprises with a Kayne Anderson Private Credit logo right in the bottom right-hand side. So I think that's just one example of, a real partnership, not just a capital provider.
Mm-hmm. When you think about your group, within Kayne Anderson, where do you see it evolving towards in the next 5-7 years? Is this kind of a pocket that continues to kind of scale up?
I mean, look, asset managers, growth is important. I'd be naive to say it's not, right? But, I think we've tried to, and I think you're going to see it now, right? Like it's a period of some testing of the sector. For a very long time, it was a relatively benign environment. Most folks are growing. You saw managers go from basically no exposure in this segment to $100 billion in this segment. And we've done a nice job of building a franchise that, look, we don't have exposure to most of the things that are causing noise in the sector right now. Not to hit on software again, but even like the perpetually offered BDCs where redemptions have picked up, like we don't have a mismatch between our funding sources and our investments, things like that. So I think we're well positioned right now. I do think that, this space generally, when you sort of take a look past, it's easy to say headlines are overblown. There's a nugget of truth in some of these things, clearly, but it does feel to me like, a handful of financial rags and papers have sort of really grabbed onto anything negative to make a mountain out of a molehill in some instances. I think that the overall structural realities is that the US middle market is humongous. There's, depends how you count it, but there's 200,000 businesses, right? The amount of private equity money that's been raised and not invested is north of $1 trillion. It's humongous. The amount of private equity companies has never been higher. There's 28,000 that are owned by private equity firms. They've never been older. They're average 6 years old, right? There's a lot of structural realities that we expect to continue to drive activity in this market, but there's probably going to be a little bit of a separation here, right? Let's separate the wheat from the chaff and folks who have been careful in how they've built their businesses over time. So we're going to keep growing, but with what we do, I think a steady sort of 15, 20% sort of AUM growth annually is, that's kind of the bogey. And that's what we've been doing for the last 6-7 years. We wouldn't be doing this in 2 years and saying, hey, we're no longer 8 billion, we're 50 billion. That's not the strategy.
Mm-hmm. Switching gears, we like to learn a little bit about the investor themselves. So tell us a little bit about yourself. Where did you grow up?
I grew up in Pittsburgh, Pennsylvania. I went to Ambridge Area High School, which is named after the American Bridge Company. So there's actually a closed steel mill a block over from, where I went to high school.
There's Pitt there, there's Carnegie Mellon, but you chose to go to Notre Dame. Why was that?
I did choose to go to Notre Dame. It was just far enough away, right? I think is probably a good answer. It was a 5 or 6 hour drive. Felt like I was going away for school, but could still get back. And look, on top of that, my dad's side of the family, he got some Irish in there, and he was a Notre Dame fan, and we watched a lot of Notre Dame football and ended up going to Notre Dame. It was great.
And did you study undergrad business there? Was it Mendoza? Is that the school?
Yeah, Mendoza College of Business. Yes, I was a finance major. I mean, I went to Notre Dame knowing nothing about finance. Like, my dad was a floor covering salesman. Nobody in our family worked in finance. I didn't know what investment banking was until the start of my junior year, when it started to get time to sort of pay attention to internships. And it ultimately got to a point of like, look, I'm a competitive person. I did well in school, was sort of looking around saying, okay, what is everybody else doing here? Not sure what I want to do. Let's do banking. Did that, ended up at Kayne Anderson, and it's been, 13 years at Kayne.
How would you compare the cultures from, obviously you went from sell side to buy side. Houlihan Lokey, it's renowned for their restructuring capabilities. I'm sure that was a good training ground for you.
Great training ground. And look, worked very hard, right? And the restructuring business, at least at the time I was there, look, Houlihan has grown a ton, right? But the restructuring business, particularly at that time, was very busy, worked on a lot of large transactions, did a lot of creditor work, which in hindsight, when I was looking to do something else and really joined what was effectively a startup at the time, right? Kayne Anderson Private Credit. But, from most investment banking backgrounds, like the restructuring background was a balance sheet oriented background and legal oriented background. You're dealing with bankruptcies, you're dealing with creditor rights, all that sort of stuff. Didn't mean to do it necessarily, but, it wasn't just like, hey, we're going to build LBOs all day, right? It was hey, these companies are thinking through strategic alternatives while they're constrained by their capital structure. How do those couple of things work together? It was great for sitting in an investor seat for the last, 13 years.
Last two questions. One is, can you tell us about a person who's had a profound influence on you?
Yeah, I've had the pleasure of working for some very dynamic people, but if I've had any success in my own career, I think a lot of it is personality characteristics around sort of toughness and, willingness to roll up your sleeves, that sort of thing. So I think if I'm really being introspective and saying, okay, what are the things that I think have really sort of helped me professionally? Like, I've got to say that, look, it's cliche, but my parents were a huge influence and really set a great example for the type of person I wanted to be. Both just fanatically hard workers, don't make excuses. They just get stuff done and, still do. So I'd say that, like, if I'm proud of anything, it's my own sort of stick-to-itiveness, for lack of a better way to put it. And I think I got to owe that to my family and upbringing.
Last question. Can you tell us about a charity, cause, or other endeavor that you're passionate about?
Yeah, so I am deeply involved. I'm on the board with a local organization in Chicago called VOCEL, VOCEL. It's Viewing Our Children as Emerging Leaders. It focuses on early childhood education. So kids that are between, pre-kindergarten, call it 2 to 5 years old. Founded by actually a former Houlihan colleague's wife. I was around right when it was getting off the ground. But the basic mission is it's underpinned by brain science and how kids that age actually learn. And the statistics on children, particularly from underprivileged communities, who enter kindergarten behind, it's depressing. Very few of them make up that gap. So if you start kindergarten not at the right sort of comprehension levels or ability to interact with your classmates, that sort of thing, the chances of that kid sort of catching up through high school, which has implications for, frankly, life path, are low. So VOCEL, the mission is to really train parents and teachers and caregivers and educators. They partner with CPS to actually help teachers say, hey, how do I, for my youngest students, how do I make sure they're actually learning? Because doing worksheets for 3 or 4-year-olds isn't the right answer. So it's something that I'm passionate about. Like I said, I've been on the board for a few years. Kayne Anderson is a big supporter more broadly. Our group, the private credit team, is a supporter. We do a gift drive every year. We supported something like 65 families last year. So look, it's not a hard sell, right? You're helping young, underprivileged kids just try to get off on the right foot, which has, meaningful impacts like for life outcomes.
Wonderful. Yeah, I look forward to researching that a bit more, and we'll certainly include a link when we post this, include the link to Vocell.
That'd be great.
Frank, I want to thank you again for taking the time. It's been a great conversation.
Of course. Thanks, RJ. Appreciate it.